Bloomberg Audio Studios. Podcasts, radio, news. This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
On the latest Masters in Business podcast, I sit down with Jeff Chang. He's co-founder and president of Vest. They are a firm that specializes in defined outcome investing, buffered ETFs. They try and remove the uncertainty of outcomes of your investing by using options and derivatives to come up with very, very specific products. I thought our conversation was fascinating, and I think you will also. With no further ado, my podcast with Jeff Chang. Jeff Chang, welcome to Bloomberg.
Great to be here, and thanks for having me.
Well, thank you so much for coming. I'm kind of always fascinated by people who have unusual or diverse backgrounds. You in particular, U.S. Naval Academy, and then an MBA from Georgetown. Is that right? What was the original career plan?
So I grew up in Annapolis. The original career plan was to be part of the Navy, and unfortunately, I got medically discharged for asthma, and then decided to pursue more of a business path, and that's what kind of led me to Georgetown. And then after Georgetown, I actually always wanted to start my own company. Right. In fact, this is kind of a funny thing. Most people don't know this. I've never actually said this. When I first started, I actually started a flat screen TV company in 2012, OEMing them from China. And do you remember back in the day, like flat screen TVs used to be like $25,000,
Oh, yeah. When they first came out, they were crazy.
Yeah. So I was in D.C. Selling those. In fact, I remember selling TVs to Reagan National Airport. So when you look at what terminal you are back in the early 2000s, those were Jeff Chang TVs that were there.
No kidding.
I think another client was Six Flags. Like when you,
long the wait.
Yeah, exactly. But then, as TVs became further and further down, I was like, hey, that's not the business I want to be in.
All commoditized. Yeah. Why do you want to be there?
All commoditized. So it taught me a lot about starting a business on, that and about life. Is that I realized that I needed actual hard skills that created a value add. And also the other component was I also realized that doing accounting books, I didn't pay too much attention in accounting. So I actually for 6 months went and studied for the CPA exam and took the CPA exam to be accounting, which was actually a twofold kind of reason. I think one of my mentors once told me is that hey, there is for the better word, there's FU money and FU skills, right? You don't have that money. So make sure you build skills in which you're not always beholden to other people. And if you thought about it, that, the two guaranteed things in life is death and taxes.
Right.
And so in my head was I didn't want to be an undertaker, but I could take the CPA exam and assure that
participate in taxes.
Exactly.
A growth industry.
So that was the reason why I took the CPA exam, was that hey, I know I would never starve because, after the failure of my first firm, I was like, hey, you always have to have at least a safety net. And that also informed me that when I started a new company, accounting is actually extremely important when you're starting a firm or even a startup for that matter. And it actually came to pass that has been a very, very important part of my career path as well.
So it's certainly a useful set of skills.
Yeah.
But I'm going to assume the first business didn't fail because of bad accounting.
Yeah.
It's just a hyper-competitive market.
That's right.
With razor-thin margins, and as economies of scale came out,
that's right,
the market just dies for that.
Yeah. And that really informed me is that you have to have an edge. I think over the 13 years of founding this company, I noticed that there were actually key features that I noticed, even going through Y Combinator, my classmates and people that built very successful companies, they had very common characteristics for their success, right? In fact, I had Asian parents. They optimized for intelligence, which was very, you get straight A's, you play the violin or the piano, and you kind of go through that
They're
process.
Optimizing for Ivy League admission is what you're implying.
Exactly. Or be a doctor for that matter.
This is so different from Jewish parents.
Yeah, exactly. So it was, and then as kind of over the years, I realized that the optimization, like if, when I have kids, because, I don't have kids, at least none that I know of, but if I did, I would optimize for actually number one is grit. Like that, and that grit is the not giving up. Like your company fails. What's the next thing? Like you pick up yourself from your bootstraps and you get up and go. It's almost like the thing is like, as an example, my parents didn't let me play video games, right? But I realized video games actually, if you introduce grit, like, if you play Call of Duty, like I was the guy that when I played Call of Duty in my 20s, I would buy the headphones that would let me hear whether or not someone's behind me, because whatever it takes to win, like that type of, you ever see that kid that does not want to lose, that like fails, but then gets up and figures out a way to win? That is grit. And
that resilience is more important than anything else.
And then the second is I realized that nothing in this world can be done alone. That success requires you to have partnerships, friendships, and know people that can help build great things. Great things don't come by yourself. And that's what I think second is influence. Your ability to let people see your dream and believe in your dream. Think about this. Like if you're starting a company, not just selling your product requires influence. Like convincing your first investors, your first employees to quit their jobs, their high-paying jobs, to make almost nothing and take equity. That's talk about like selling a dream. That's influence. Like think about, some of the greatest entrepreneurs out there. You probably heard like Steve Jobs as a reality distortion field. You know what that is? That's influence, right? That is one of the key things I think when you're looking at business. Influence is such a key thing of something that required to have success. Because like I said, nothing in the world is done alone. This third, which comes back to my point, is creativity. The ability to spot things that other people don't see, right? To basically be, to see opportunity, to see things, to combine things together and have that opportunity. And then the last, if you combine it, is intelligence. If you do all four, and I can give you examples of people who are immensely successful just with grit. And by the way, it's in that order: grit, influence, creativity, and last is intelligence.
So I want to stop you there for a sec, because I want to spend time going over Y Combinator. I want to talk about VEST. But before we get there, I mentioned the Naval Academy. You have such an unusual background. Talk a little bit about what your experiences were like at places like Freddie Mac, the World Bank, FBR, and ProShares. That's such a diverse set of experiences. What did you take away from that life experience, and how did that ultimately lead you to launching your own firm? Yeah, so I could tell you one of the best things about what the military teaches you is not just teamwork and looking after the people next to you and really making a commitment. But there's also another thing is work ethic. Like I could tell you that I'm a morning person. I didn't grow up a morning person. But it's like 5 a.m. I'm up. And the funny thing is my girlfriend's a night person. She's like, how are you like sprightly at 5:30? And I was like, that is actually learned behavior, right? So that was like kind of the first thing of learning grit and tackling the day early on, making your bed, those small things in life, I think have been really, I'd say, important and kind of keystone in that process. The second is actually when I first started my first job at the World Bank after trying to start my company, I had to translate energy companies in China. And I had two problems. Number one was my Chinese wasn't good enough. And secondly, my accounting wasn't good enough. Hence the CPA came in. I was like, at least I got to learn one. And then I cut over to Freddie Mac. And if you remember, during the 2002, 2003 timeframe is when Freddie Mac went into restatement. Mm-hmm. So as a certified public accountant, I was extremely sought after at that time. So I worked at Freddie Mac, and I realized that I really wanted to – I read Liar's Poker
by Michael Lewis, and I realized that I really wanted to trade mortgages. So I started
which, by the way, he said he is horrified because he thought this was a cautionary tale.
Yeah.
And all it did was encourage more people to go to Wall Street.
Totally. Reading that book really made me want to be, what he said in the book, big swinging, right? Like everybody, it was just such a fun story. It almost painted Wall Street in a specific way, but it was just the interesting part. And by the way, it also got me into reading Fabozzi about fixed income, about the mortgage market. And then I wanted to be a trader. So, I studied for the CFA exam. I got my CFA charter. I didn't know that would lead me to over a decade of teaching CFA.
Right.
But that was really fun to do that and kind of give back. So trading mortgages, Freddie and then FPR, I got to trade during 2008. I got to have a front row seat to seeing the Bear Stearns, Lehman. I remember trading repo during the 08, September 08. It's the month I lost all my chest hair in in 1 month. But it was fascinating. I mean, that's what I thought finance was like. So then, later on I cut over to convertible bonds and options. Then the flash crash hit in 2010, which was, by the way, I'd never seen an entire trading desk stand up within 1 minute of everybody's like, what's going on? I got to see a lot of Wall Street in my 20s and 30s. It was definitely a formative time of understanding, kind of what made capital markets tick and understanding, and also understanding the pitfalls, the hubris of finance that,
well, that has to be the big takeaway from 08, 09 is that markets go up and down. And if you're leveraged, it's a problem. And if you're highly leveraged, it's usually pretty fatal.
Yeah, exactly. And, and disasters are always clear in hindsight, right? And you look back and you're looking at 20, 30% default rates. You're like, why? That would have been so clear in your mind when you started to look at some of the data. And so that was really formative. And the other component is kind of like what Warren Buffett says. You always know who's not wearing pants when the water goes out.
Yeah, when the tide goes out.
Yeah, exactly.
Sure.
And so I always, I'd say, think about, hey, if the tide goes out, make sure the money we manage for our clients that we got pants on. Right?
Risk management turns out to be more than just a phrase. It's really important if you're running other people's money.
And it's something that you live and breathe. And what I actually, a lot of our investment products is to try to get our clients to understand that and utilize kind of a lot of the tools that we build are basically pants. Like, when the water goes out, make sure that you have something there because of uncertainty.
That's to say the very least. So let's talk a little bit about that. You come out of this experience on a desk through the financial crisis. Mm-hmm. You launch Vest in 2012. What was the motivator? What led you to say, hey, I think we could do this better?
Yeah, so I had a very short stint at ProShares where I met my co-founder, Karan Sood. He worked on the structuring desk at Barclays, and we talked about, hey, let's start our own firm. And then our first idea was going to be, buffers, like downside protection that we saw in the structured note market. And by the way, this actually segued into the mortgage crisis because in 2008, the largest issuer of structured notes was Lehman Brothers. Mm-hmm. Right? Like you have 100% protected note, and then now you're standing in bankruptcy court. So that was a big change in the industry. I think the structured note industry went from 120 billion to 30 billion in that time frame from after the 2008 crisis. So
I'll tell you a funny story. I was a market strategist at a brokerage firm in 02, 03. Mm-hmm. And we got pitched a downside protected SMA. Mm-hmm. And I was just sitting in a conference room hearing this pitch. What are any questions? And I didn't ask the obvious question that I thought, which was, well, great, the NASDAQ's down 81%. Where were you 5 years ago? Who needs this now? But the question I asked and got called into the corporate counsel's office for was, hey, what about counterparty risk? How do we know that you guys are going to be there to make the trade good. Sir, Lehman Brothers has been here for 189 years. It'll be here long after you're gone. I'm like, okay. No, it's an actual risk that no one was even discussing. It was just assumed. So it turned out that counterparty risk is a real thing.
Oh, it's a very real thing.
So we're going to talk a little more about Vest and buffer funds in a moment, but I just want to get the timing right and talk a little bit about your experiences at Y Combinator. You launched Vest with your co-founder in 2012. You joined Y Combinator in 2015. What led you to saying, "Hey, let's see if we can hook up with the guys over at Y Combinator"?
Yeah, so that's the thing in finance is there's not too much innovation, right? Because it's a lot of regulation and so on and so forth. And so even at our company, we always, even our identity today is still, Silicon Valley meets Wall Street, right? Mm-hmm. I always think that, like, in my mind, if, someone in Silicon Valley were to come into our business, they could end up in jail. Right. Or if Wall Street ends up in Silicon Valley, you might be, just end up in a ditch because,
you'll get run over for sure.
Yeah, exactly. Because at the end of the day is, we went 4 years with no income.
Wow.
Right? Like, lived off our Wall Street bonuses, me and my co-founder, Karan Sood. Like, we didn't get paid for, 4+ years to found this company. Like, that's how much you have to, the grit and the belief in something. And that culture really, really, I think, comes out of kind of startup, kind of the Silicon Valley area. Y Combinator, at the time,
Run by Paul Graham, is it?
Paul Graham, was the first year Paul Graham stepped down, and Sam Altman, when I showed up, was president of Y Combinator. So
2015? I didn't realize it was that long
2015,
ago. Wow.
yeah. Sam was president of Y Combinator. And for the folks out there that don't know, so YC, similar to like a college application, you fill out an online college application. You actually don't need a company. They help you form the firm. And, the companies that have come out of that program, Airbnb, Reddit, Coinbase, DoorDash, OpenAI was funded by YC Research. So all of that, all of those firms came out of YC. So, in fact, I think I read a book called The Launchpad, which talks about YC, the companies that there. I mean, the first class of YC included Sam Altman, Justin Kahn, who founded Twitch, and Alexis Ohanian, who founded Reddit. And I think there was correct me, maybe 9 companies. I mean, that's a all-star cast, if you ask me,
absolutely.
For a class. And so it was definitely someplace that we wanted to be around. There weren't a lot of finance firms. In fact, Vest is the largest asset manager to emerge out of YC. So it was definitely something to try something different and really get into the Silicon Valley and really push the innovation within finance.
I don't know if this is still the case, but a couple of years ago, the standard deal was something like $500,000 for 7% of the company, plus a 3-month program of building, iterating, pitching, et cetera. Right. Is that more or less sound right?
That's right. That's the deal today. Our deal was probably close to 1/5 of that.
Oh, really?
Yeah.
Well, 10 years ago, a lot has changed over the last decade.
And they have done a great job. I think they have maintained their I think the stat was since 2012, 20% of the super unicorns were funded by Y Combinator.
Wow, that's amazing.
And then second place is 3% and plus or something like that.
And this is like a full-on boot camp where it's 3 months and they are really taking you through the process. Here's how you build a startup. Here's how you iterate. When you first joined YC, did you have any idea what the final product of Vest was going to be, or did that experience clarify where you wanted to go?
There were certain we went in with the idea of buffers and downside protection There were certain pivots as far as like, hey, what's the best delivery vehicle to start with?
Meaning an ETF as opposed to an SMA?
Versus, exactly. But that was the foundational. If you even look at our application, our pitch, it was exactly talking about the need for downside protection, the need to fix liquidity and credit risk and other types of instruments. Those were kind of the foundational problems, because YC always says that, like, make something that people want, and then don't just come up with the ideas. Start with the problem.
You're solving for a specific problem.
And the problem needs to be painful enough. And so anybody out there that's ever thinking about starting a startup, always start with the problem first, and make sure the problem is painful enough for your customer that becomes, how you solve it can change a little bit, but the problem always existed. And we thought that was a noble problem and a painful enough problem to seek.
That's a very customer-focused approach to building a business. I don't know if Wall Street necessarily thinks in those terms. There tends to be an attitude of, this is how it's been. It's been successful. Why do you think you're smarter than everybody else, smarter than the market? Like, that's a sort of pushback you've gotten, and that you tend to get when you roll out a different approach.
That's right.
How has the experience been marrying the Wall Street ethos, where failure is abhorrent, and the Silicon Valley mindset, which is, hey, failure just gets you to the solution. It's just one more step.
And that's where kind of the ethos of our Silicon Valley meets Wall Street is that we live in both worlds. Like, our background, me and Karan's, are Wall Street backgrounds. That there is no move fast and break things mentality on our Wall Street ethos, right? It is measure 4 times, cut once. This is people's livelihoods, their wealth. So that part we did not adopt. Not like break things type mentality. That is not.
It's hard to do that when you're a highly regulated industry.
Exactly. Second is that we also realize you can't do this alone. It's not like we're starting an Airbnb where we can just kind of do X, Y, and Z. We needed partnerships. We needed, like, coming back to the point of influence, like, we needed people that really could help us with innovation. Hence, we actually only have 2 investors. One is Siebel Global Markets, the Chicago Board Option Exchange, the largest option exchange in the world. And First Trust, one of the largest ETF providers here in the United States. That has been intricate in the ability to shape and mold the industry, just like even with the exchange. Like,
wait, let me roll you back. You said you only had 2 investors.
Today.
Yeah. All right. So before we get there, let's talk about the post Y Combinator experience. So they give you barely 6 figures for a small chunk of the company. They take you through a boot camp that teaches you all these different things, from focus on problem solving to iteration to pitching investors. Yeah. Who were the early investors invest?
So we had our lead coming out of Y Combinator was First Round Capital. People aren't familiar. That's the company.
It's a great name if you're doing venture investing.
Exactly. They were one of the first investors in a small company called Uber.
So that worked out okay.
Yeah, they got a lot of big wins there. And after that, we had kind of a party round of a lot of different angels and other smaller VCs. But after that, that's when SIBO came in and wanted a bigger stake of the firm. But the whole YC experience was very much like the show Silicon Valley, right?
Which I just loved. So great. And
to the point where, like, when we got to YC, we rented a hacker house. By the way, the house that we rented was called Hacker House. And it was a 1-story building with like 3 bedrooms, not enough bedrooms for all of us that were working there. I think Karan had to sleep on the floor on a mattress for 3 months. And by the way, this is coming from being over a decade on Wall Street. Like, we're now sleeping on the floor.
Hey, there's nothing to do but get this done.
Exactly. And this is why I say, like, sometimes, like, if a former trader on Wall Street ends up in Silicon Valley, they may end up in a ditch, because, like, you have to go 4 years, no pay, sleep on the floor. It's not fun. Where you're used to, like, wearing wearing, suits and loafers on Park Avenue, it's a big shock to the system. But that's the thing is like, at the same time, it's okay sleeping on the floor. It's better than sleeping on the ground when you're in the military. But that's the grit that you kind of go through, right?
Coming up, we continue our conversation with Jeff Chang, co-founder and president of Vest, talking about his experiences at Y Combinator. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. My extra special guest this week is Jeff Chang. He is the co-founder and president of Vest. The firm manages $50 billion in ETFs that are described as outcome-oriented investing. Some people call them buffer funds. So you have this experience with Y Combinator. Any of that graduating class with you, you're still in touch with? Who else were?
Oh, yeah. So I'm not sure if folks out there know GitLab.
Oh, of course.
Sid was our group.
No relationship to GitHub, which predates that by a long time.
But GitLab was I think they IPO'd on the NASDAQ, I think over $5 billion or something like that. Mm-hmm. They're doing really well. There was Equipment Share. Was also our batch. A lot of big winners in our. And by the way, you've probably been to college where you go into a lecture hall, right? And you have your first day of class. The first day of YC, you know what they tell you? They're like, 4% of you guys in this room will be billionaires.
Right.
No
intimidation factor.
By the way, that's the math, right? Like on average, it's a 4%. I think right now it's like 5 to 6% unicorn rate. But how many classes can you go through that you're like, hey, 4% 4 to 5% of you guys are going to have extremely successful companies coming out of this class. And by the way, you look around, you're like, oh man, is that really possible? And then you blink 13 years later, you're like, wow, really did happen. Like there's incredibly successful firms and incredibly successful people. When you look back and even now, I look at my group partners. I look back, my group partners were incredible. I had Gary Tan, who founded Initialize, and also is now the president and CEO of Y Combinator. Alexis O'Hannon founded Reddit. Justin Kahn founded Twitch. Kat Melinek, who was like an all-star in marketing and PR. Like I had an all-star group.
It definitely sounds like it. We're talking about winners, but Silicon Valley wears losers like a badge of pride.
Yeah.
Like it's, hey, this is what's expected, which is very different than the way the East Coast tends to approach things. Tell us about that, not being afraid to fail, not being afraid to try things, iterate, and take, this doesn't work, let's go with that. How different is that experience on the West Coast than what you experienced on Wall Street?
Yeah, I mean, definitely in Silicon Valley, failure is okay. They have a saying, if you're going to fail, fail fast, right? Whereas I feel like on Wall Street, it's like you don't want to fail fast. Like that's called a blow up, right? So there's some parts, given the industry that we're in, we have to ignore some of the aspects of it. I think everything that we did, I wouldn't say was ultimate failure. Maybe not the success that we wanted, because we wanted to make sure everything we built were strong in foundation, right? It would stand the test of time no matter what happened. Maybe not wildly successful, but then that's how you pivot. So it's not necessarily failure per se, but not the success you're looking for. Then pivot and try to find other ways to deliver and how to solve the problem better. But I still think that the idea of not being afraid of failure and that grit and the ability to pick yourself up, it's that attitude that this is not the end. Failure is just the mother of success, and you just have to keep learning from those mistakes, because everything is a learning process. I can't tell you one person that I know that's successful that has not failed.
No, that makes perfect sense. You don't know what's going to work, and you don't know what's not going to work until you try.
Yeah.
And if there's a story about, hey, if you're not failing occasionally, then you're just not taking enough risk.
Yeah.
say the very least. All right. So let's talk a little bit about how this developed. You come out of Y Combinator sometime in 2015. When did you first start taking client assets, client money?
Well, in YC, we were taking client assets. I think we launched our first mutual fund in 2016. It was the first buffer fund of its kind. And then...
So wait, let's stay with mutual funds, which have their own complications with capital gains tax.
Sure.
Given what you do primarily with derivatives and options in order to create that buffer, how does that play out in a mutual fund wrapper?
Yeah, there are obviously challenges that may not be as, let's say, the same as like an ETF that, in 2019 they introduced the in-kind. This is also another example of the partnership with SIBO.
It's been around for real estate for forever, it seems.
That's right.
And it just took Wall Street a while to catch up to that. Explain what in-kind creation and redemption looks like and what it means to you.
So in mutual funds, there's a challenge in some cases that if there's a redemption, you would sell your securities, which could have the potential to realize gains. In ETFs, and not just unique to these ETFs or all ETFs, they have the ability to, let's say, in-kind securities. So when someone wants their money back, instead of giving the market maker selling securities and giving them cash, in some cases, you can give them securities, thereby not potentially realizing the gain for the shareholder. So it has the potential for tax efficiency by having in-kind. Now, prior to 2019, October of 2019, that was not we weren't able to do that with options. That was introduced in October of 2019. So we launched our first buffer ETFs in November of 2019 in partnership with our partners at First Trust. And so that has been one of the fastest growing areas, not just for our firm, but as the ETF industry as a whole.
So let's talk a little bit about what a buffer fund does. What are the advantages? What are you giving up in order to obtain those advantages? What's the largest fund? What's the largest ETF now at Vest?
So the largest buffer fund and the one at Vest is BUFR. Mm-hmm. And it's
good
built,
ticker.
Yeah. It's built on the foundation that, the kind of fundamentals of the strategy is the buffer strategy, which is, let's say you get S&P exposure for 1 year. The first 10% is protected. So as an example of strategy, if S&P is down 10, you're flat for the year. And then you get upside up to, let's say, a predetermined cap. So let's say S&P is up 15, you're up 15. But the most you can make is 15. So if S&P is up 16, you're up 15. Right. So you're capped out at that 15%.
So years
upside.
like 23 and 24 are kind of unusual. Sure. You don't usually see 25% 2 years in a row. But if you were in the fund in 22, down 22% means you're only down 12%. Is that right?
That's right.
So that's the trade-off.
Yeah. And here's the thing is that most people don't realize these strategies have the potential to outperform the market, even if you're talking about, high double-digit equity returns. Because think about this. In 2022, because of inflation, when interest rates went up, stocks and bonds both went down at the same time, right? You could have mixed your stocks and bonds any way you wanted in 2022.
60-40 was negative in 2022.
And unless you were managing money 40 years ago, you had not experienced inflation, right? And you couldn't hide anywhere. I mean, you were like Tom Brady choosing between alimony and child support while taking your kids to jiu-jitsu practice. Right. Like the thing is, there was nowhere to hide, right? Right. Whereas if you were hedging, and the great thing about hedging is if you buy S&P and you buy an S&P put, that put is perfectly negatively correlated to S&P.
Right.
It's like buying insurance.
It's an inverse. It's the opposite. Right.
And so imagine if you had a strategy that did not participate in the majority of the drawdowns in 2022. That means you had more to invest to take advantage of the gains in 2023, 2024, and 2025. This is the compounding effect of winning without losing, right? Mm-hmm. It's the compounding effect of playing offense and defense at the same time. Because the end of the day is a lot of times, these types of strategies are not the get rich game. If you're 20 years old, probably not the strategy for you. But in our industry, a lot of the people that have wealth, they're in the stay rich game.
Right.
These types of strategies are in the stay rich game because if you have wealth, you just don't want to be poor, right? So that's the kind of crux of protecting your equity exposure. And the idea is the issue with hedging has always been that to hedge with options and so on and so forth, one of the biggest, and they had surveys on why, investors and financial advisors don't hedge with options. And everybody said the same two things: compliance and scalability. Mm-hmm. The compliance burden associated with trading options and the scalability. Because when you buy a fund, you buy a stock, you could put in your portfolio, fall asleep for 30 years. Maybe you rebalance once a quarter. You buy an option every 30 days, 60 days from now, you have to trade it. By having it inside a fund, we can trade that for you. And so now you can asset allocate, rebalance once a quarter. It solves a lot of those issues. And this is the thing that I find very interesting is two things. Number one is these strategies have been around for over 30 years. The buffer structure note has been around for years. Buffer annuities, I think, were introduced in 2010. All we did was cut the bank and insurance company out. Like, instead of having the bank or insurance company hedge themselves with options and then issue you a policy or issue you a note, we just said, why not just put the hedge in a fund and now you own it? We cut the middleman out of the middle. Mm-hmm. The other component is to think about in business that I always look back. So Richard Thaler, the professor at University of Chicago, won the Nobel Prize for behavioral finance, right?
Essentially created the field.
Yeah, the nudge. And I believe one of the studies by Cornell University had this study of I think they had kids in the lunch line. They gave them free apples. Like, you get to the end of that, you get a free apple, right? By the way, the consumption was like less than 20%. Like, it was a very low consumption rate. No one took the apple. Then they cut the apples up and they put them in little bags. By the way, the consumption went through the roof. Why? This was the nudge. This was the idea that you make it simple, people will use it. Think about options as apples. And then that we had bagged those apples to make it easier for the user to consume them without the compliance and scalability burden to them. Because theoretically, any broker or any financial advisor out there can actually trade those themselves. But that's like the same thing. Like, every child could sit there and slice their own apples, but they don't want to do that.
So let me ask you, because you've brought this up a few times and I want to hone in on this. Is your target consumer mom and pop Main Street investors, or are you focused more on the advisor channel or brokerage channel, or all three, some combination?
We are not that focused in the retail space. Mm-hmm. Mostly, and by the way, I would say 100% of our focus is in financial professionals.
Really?
Because those are our partners. Those are the people that we stand side by side with. We build products those are the people, we're solving problems for them, which they're solving problems for their clients. We stand side by side with the financial professionals that manage,
and once you bring them up to speed, it's incumbent on them to find the clients that think are the right fit for this, and they get to explain that.
Exactly, because every single client is different and unique. We make products across, and every client is different, and how that gets utilized. We help the financial advisor even how to best build and achieve their clients' investment objectives. But as far as the end client, that's typically not our customer.
So I mentioned 60-40 earlier. Does a buffered fund act as a substitute for a 60-40? In other words, if you own, whether it's 60-40, 70-30, you own bonds for income, of which there hasn't been a lot over the past 15, 20 years, but also as a non-correlated asset with equity, other than 81 and 2022. Does this, and it offsets the volatility and drawdowns in equities, do buffered funds behave similarly to a 60-40? Is that the thinking?
I wouldn't say similarly. Let me give you kind of how we think about it. So if you look at, let's say, a strategy of a 10% buffer on S&P, in fact, there are indexes out there that track these. If you compare that to, let's say, like a BlackRock 60-40 portfolio, you actually notice the standard deviation is almost identical. The volatility is very similar. right, over the long term. But the source of the risk management is different, right? You're actually hedging. You're not hoping that the correlation between stocks and bonds, the negative correlation is there, that, when my stocks go down, I hope my bonds go up kind of situation, right?
Well, historically, they do most of the time. They didn't in 2022. They didn't in 1981.
Exactly.
So it's every 40 years or so we seem to get this
Or
headache.
with inflation at, 3%, what happens if inflation rears its head again? In
The next rising,
Exactly.
you'll end up with the same issue the next time we see a serious set of rate
and
hikes.
This is why we say, why not diversify your risk management and hedge? So if I have a $100 portfolio, and let's say I have $60 in equity, $40 in fixed income, and let's just say I take $10 out. I put take 6 from equity, 4 from fixed income, and I put it into, let's say, a 10% buffer strategy in S&P. Perhaps the standard deviation of the portfolio could be very, very similar, but notice the source of your risk management has changed. You've introduced hedging as the source of your risk management, without the compliance, without the trading scalability issues of options. You've introduced hedging as the source of risk management if inflation were to rear its head. Because the thing is, this is what everybody needs to ask themselves. If inflation were to come back, right? Which is there's a
non-zero possibility and way above that.
Yeah, exactly. What in your portfolio is going to save you if 2022 repeats itself? That's the question everybody needs to ask. I always get the answer, commodities. Great. Commodities, it's a timing trade.
Right.
You can get in, it'll work. But when it's not inflationary, what happens to that trade? Let
me point out that gold didn't do great in 21 or 22.
Yeah.
It's only in the past few years where it's really exploded higher.
That's right. So I'm not smart enough to time that trade. And that's the great thing about these types of solutions is you don't have to time the trade, right? Like you're diversifying your risk management through just hedging. And like I said, repeat it again, this is the stay rich game, right? How do we protect wealth? Not like make exorbitant amounts of it, but protect wealth and get a decent return from people's wealth.
So buffer is 10% hedged on the S&P 500. Tell us about some of the other ETFs you guys run.
So one of the kind of overall themes that we've seen in the market is, the two things that really people are looking for is downside protection. But the other one is income generation. As the boomers are in retirement, the need for yield has really shown how high it is. I mean, if you look at the derivative income space, I think in 2018, Morningstar was ranked 58th. Last year, it was ranked 9th in flows, right? People are looking for income. And as volatility goes up, just like strategies like writing cover calls are extremely, it's another way to derive yield by monetizing volatility in different asset classes. You could do it in gold, you can do it in Bitcoin, you can do it in equities, you can do it in fixed income. And that's the thing is people were always thinking one-dimensionally, that like the innovation is always about thinking three-dimensionally when everybody else is thinking in two-dimension, right? This is why we have, built strategies to derive income from, not just equities, but fixed income, but from gold, from Bitcoin, from any asset class.
So give us a few ETFs that are primarily income focused.
Yeah. So one of our biggest ones is KNG, which tracks the dividend aristocrats. RDVI, which tracks the dividend achievers. These all provide, attractive level of yield. I think.
So dividend aristocrats tend to be high dividend, low price. They tend not to be high PE companies, so they're fairly stable. Is that?
So the companies that have grown their dividend, this was created by S&P back in 2005, companies that have grown their dividend for 25 consecutive years.
Wow.
And these are dividend growers. They're not dividend payers. So they typically, I believe, yield less than 2%. But they've grown their dividend for 25 consecutive years. So for a company to grow their dividend for 25 consecutive years.
That's a stable business.
Yes. And it has to cash flow. It's not a PE play, right? For all intents and purposes. It is companies that have to have strong moats. And the other thing that people miss is good corporate governance. Because who makes dividend policy? The board. For a board to never cut a dividend for 25 years, it actually was a filter for good corporate governance. Now,
and that stock symbol is, that ETF symbol is?
KNG.
KNG.
Yeah.
And you guys generate additional income on that with covered call writing.
That's right.
So if it's a 2% yield, what do you actually
generating? Our distribution yield probably in the past year over 8%.
Really? That's a big number.
And we're on average, I believe, covering around 20% of every single name. So, if I have 100 shares of Walmart, I'm writing an at-the-money call on, let's say, 20 of those shares as an example to achieve that target income. So one of the things, that core beliefs that we have when writing cover calls is like one of the biggest drivers is stock selection. Mm-hmm. You pick good stocks, you get good results, right? While, the aristocrats, they don't have the high-flying Mag 7 names.
Right.
But definitely, as you look forward into the windshield, these are really going to be the names as the market broadens out, right? Like, I really do think in the next year, you're really looking at kind of a barbell approach where you have the NVIDIAs and the high hyperscalers in your portfolio, but you really need to have the strong staples, that cash flow. Especially,
what are some of the names in KNG?
Well, you got like Chevron, Walmart, like your really blue chip names that are there. I mean, look at Chevron. They have the potential to be, one of the beneficiaries of oil in Venezuela, right? Like they were there before, and these are the cash flowing like creme, like companies that like I said, grown their dividend for 25 consecutive years. These are strong names that are out there.
Do you do anything with fixed income on the yield side as well?
Yeah. So we have cover calls on high yield, tracking HYG, gives you also, I believe, a double-digit distribution yield, only covering about 20 to 25% of the portfolio. So you're still getting over, on a weekly basis, 70.
And what's that ETF symbol?
HYTI, Heidi.
Mm-hmm.
Yeah. And
what about do you do anything on the commodity side?
So we have gold, IGLD. So, biggest knock on gold has been that hunk of metal sits in your portfolio, doesn't do anything. Now you can monetize the volatility and have, potentially.
Same process, covered call writing.
Exactly.
So this is why SIBO is a partner with you guys. How does that relationship help you manage all of this option writing, all this call activity?
That's a great question. So let's take iGold as an example, right? Prior to that fund, GLD options stopped trading at 4 o'clock. Mm-hmm. By the way, this is one of the reasons why SIBO partnered with us is how do we solve certain issues in the option market for the construction of funds, right? If options stop trading at 4 o'clock and I need to know the close, I can't create an ETF on that.
That's right.
S&P options, SPY options, they close at 4:15. Mm-hmm. Today, GLD options stop trading at 4:15. By the way, that's a really cool statement to say that the entire street trades GLD options that extra 15 minutes because we wanted that.
That's great.
But that's
because you have to take the closing price at 4 and then use it for an end-of-day hedge.
We need that option market to be open that extra 15 minutes. And by the way, that those products by First Trust Invest are the reason why we have an extra 15 minutes to trade GLD options. So if you're late and you're trading at 4:05, that's us.
And option trading is so much more complicated, so much more difficult.
Yeah.
Like you, I started on an equity desk, but have always been a little bit of an option junkie because it's so fascinating. And most people don't use options correctly. They're just making like a lottery ticket bet, which tends not to be smart. You guys are using options for a very specific purpose to achieve what you describe as a defined outcome result. Solving a problem.
Starting with the
really
problem.
Interesting.
Yeah.
Coming up, we continue our conversation with Jeff Chang, co-founder and president of Vest. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. My extra special guest this week is Jeff Chang. He's president and co-founder of Vest. The firm specializes in outcome-oriented investing via primarily ETFs. They run over $50 billion in assets.
Yeah.
Before I get to my favorite questions, I wanted to ask so we've covered stocks, bonds, commodities. You mentioned crypto. What are you doing in terms of crypto and generating additional defined outcome results using derivatives?
Yeah, so we have a strategy, also target income, almost, I believe, about an 18-19% yield, and you're still only covering about 20%. So that strategy tracks Bitcoin. So you can get on a weekly basis, let's say, 70-80% of the upside in Bitcoin, and then a really high, almost 20% yield by monetizing the volatility. It's the same thing because just like gold, some of the knock is that it just sits in my portfolio, doesn't do anything, and the value.
Well, no one could say that about Bitcoin. Yeah. It's always doing something, either going up or going down.
Yeah, exactly.
And what's the ETF symbol for that?
IBIT.
Uh-huh.
I'm sorry, not IBIT.
That's BlackRock.
That's right. Yeah. DeFi, DFII. That's right.
DFII.
Yeah.
And so that's options. How much of the upside, how much of the downside do you get and give up, or is it just geared?
We're just writing cover calls to target, a specific yield. Like I said, I think we're covering every week about 20 to 25% and at the money.
How often do those roll?
Every week.
Every week?
Every Friday, yeah. The reason why we like weeklies is that when you sell a call, you want the premium to go to zero.
Right, that's right.
And that decay accelerates in that last week if you're selling a monthly option. So if you do it 4 times a month, you have the potential to generate more yield because you're always capturing that extra decay. It's like football tickets, right? Like you ever go on StubHub, game times at 1 o'clock, and you go on StubHub at 12, the ticket starts to drop like a rock. Imagine if you kept tracking that and you made money off that drop, right? And everything kind of follows that. In fact, there's actually only one thing that doesn't follow that. You know what that is?
Go on.
Giants tickets. They decay before the season starts.
Well, as a guy who used to be in New Jersey, for sure.
Or Jets tickets. Actually, both of those are an anomaly.
So in other words, bad assets don't generate good option returns. That's pretty reasonable.
Yeah.
How often do things get called away? That's obviously the risk when you're writing calls.
Sure.
How do you manage around that? How frequently is that built into your models?
I mean, that can happen pretty frequently, but here's the deal. Like think about this. And this is just a concept of let's say I collect a $2 premium and the stock goes up $1.
Mm-hmm. You're good.
Yeah. I made a dollar, but it still got called away, but I still made a dollar. I just buy the stock back or however way I deal with the assignment, depending on the strategy. So the idea is as long as the stock doesn't go above the premium, if I'm writing out the money or what I've actually
it gives you a buffer to repurchase the stock, not at a loss.
Exactly. And this comes into what we call about the implied versus realized premium, meaning options, if I look historically of a particular asset, whether it be a stock or a commodity or whatever, and it historically moves X, I'm not going to sell the premium at that number.
Right. It's got to be X
plus, right? Just like when you sell car insurance, if my expected loss is $1,000, I'm not going to sell the premium for $1,000. I'm going to sell it for $1,200 to make $200, right? That extra little bit.
Right. So
in options, they have what's called the implied versus realized premium. And so that's really kind of where you're trying to capture is the implied volatility versus what the realized volatility. And you're hoping that the implied will be greater than the realized. I mean, that's the hope in options, especially when you're selling them. All right. I think there's a stat that 60% or 70% of the time, the person selling the option wins the trade, right?
Right. Most, old option traders don't die. They just expire worthless.
Yeah,
is the old desk joke. But, if you're a writer of options, you're making a very specific bet.
Yeah.
And if you're a purchase of options, you're making a very different bet.
Yeah. I mean, you see this, in some cases of buying options, like you said, it can, even Warren Buffett said there could be weapons of mass destruction. I mean, you can see these 0-day options that people are buying.
Yeah, that's become crazy.
I mean, those are like scratch-off lottery tickets. right? Who's buying them? I don't know. The kid in his mom's basement popping his pimples, eating mayonnaise sandwiches. I don't know.
At one point in time, I imagine that there were market makers that had a hedge that for reasons that were complicated, they were stuck with overnight positions. Like, I almost understand that. But the day traders playing with these, this is FanDuel's and DraftKings pure speculative nonsense.
Yeah, exactly. So that's why we don't have anything in that space, but it is something to look at from afar.
Really, really fascinating stuff. Last question before I jump to my favorite questions. So you're constantly thinking about, how do we hedge this position? How do we create a buffer? How do we define a specific outcome for clients? What do you think the average investor isn't thinking about relative to that approach, but perhaps should be? What do you think most people are kind of missing or not paying enough attention to? And it could be a geography, it could be a policy, whatever. But you're obviously thinking about a lot of things differently than the typical index purchaser. What are we missing?
Yeah, I think, while we've had a tremendous amount of growth in kind of the option space of downside protection and the income generation part, I think a lot of the market is still, thinking two-dimensionally in stocks and bonds, right? Like, instead of just diversifying across, you can still diversify, but think about other ways to shape your return, right? Or thinking about income generation out of the equity portfolio. Think about income generation or boosting yield in your fixed income part of it. And then also thinking about risk management beyond diversification. While there is a lot of good part of the financial professional space that is picking up on this, I still don't think we're just tip of the iceberg at this point, right? That's on one standpoint. I think people are still missing. The second, I think is I think one of the biggest drivers of the market today, and no one would disagree, is AI, right?
Sure.
However, that's not the part that people are missing. That, having been through the 2000s, I really feel like this is like 1999, 2000. Like, think about the stocks that were big then, right? Like, you had
Juniper Networks, Metro Media Fiber,
AOL,
right?
Like, you guys remember Priceline?
Global Crossing.
Yeah.
Well, a lot of these companies have been either absorbed into other companies and still Priceline, Expedia, there's a through line there.
Totally.
How is Pets.com not Chewy today?
Yeah.
So some of them were just a little early.
Exactly. So now let me ask you, who won that trade? Facebook, Google, Netflix, Amazon,
Apple, Microsoft.
A lot of those companies were private or startups then.
Google.
Right?
Yeah.
Think about that. And I think that's the same. History doesn't repeat itself, it rhymes. I actually think a lot of the kind of the hugely successful companies from AI are in startup mode. They're at Y Combinator. 90% of the almost 80-90% of the companies at YC are AI driven. I've seen an article recently, their month over month average for the batch is double digits, meaning their revenue is growing over 10% month to month,
wow.
or in some cases week over week.
That's unbelievable. And I said to someone the other day, someone said, who's going to dethrone NVIDIA? And I said, the founder of that company hasn't graduated high school yet, but he's coming or she's coming. It's not impossible. All right, let's jump to our favorite questions that we ask all of our guests, starting with, who are your mentors who helped shape your career?
Oh, that's a great question. I would actually have to say my brother.
Really?
Yes. And
in what way?
I have an older brother. He's 4 years older than me. Mm-hmm. He's the overachiever. I'm the underachiever of the family.
Okay.
So my brother, I remember growing up, he was like he was good at math and science. I would literally show up to class and they'd be like, "Oh, you're Bill Chang's brother. You must be smart." By the way, you know what that does to you? It's like a
lot of pressure.
Yeah, a lot of pressure. So he went on. He worked at Apple and then was at Tesla. I think he was chief architect of the Dojo Dojo project. If folks that aren't familiar with Dojo, it's the AI system at Tesla that coded the self-driving, right? He recently, and in fact, Bloomberg wrote an article about his firm, Density AI, that I think they are one of the first companies to really kind of take on, because the Dojo, I think, system is one of the more efficient ways that can take on NVIDIA for the chip. So that's why it's funny that you said, like, hey, the person that's going to dethrone NVIDIA may still be in high school. I was like, yeah, he might just be 4 years older than me.
Right. Yeah. Or he could be deep into the process already.
Yeah. So they recently, like I said, like Bloomberg just wrote an article about them on Density AI. And he has been extremely, like, a lot of times people ask, like, hey, did you work that hard because your parents were, like tiger parents? No, actually, I was just chasing my brother the whole time. It was definitely a different dynamic. I couldn't be more proud of him. And a lot of times people are like, hey, what tea are the Changs drinking? Because but we get along great. While we're competitive, we support each other. But he has been. You're
in different fields, so the competition stops.
Exactly. He's in engineering. I'm in
financial engineering.
Yeah, exactly.
So similar background.
Exactly.
Let's talk about books. What are some of your favorites? What are you reading right now?
Well, I said Liar's Poker was a very influential
Classic.
one. Yeah.
Just had its 30th anniversary, I think, last year.
I like. I thought was really good for me was the book Influence by Robert Cialdini.
Fantastic.
It was a great book. Kind of along with that, How to Win Friends and Influence People. I think those are great. I actually, in finance, one of my first ones was The Intelligent Investor by
Ben Graham.
Yeah, Ben Graham. Those are kind of cornerstones.
Yeah, that's a great list.
Yeah.
I know you are on planes a lot.
Yeah.
When you're not reading, what are you streaming? What's keeping you entertained on these long cross-country flights, either podcasts or Netflix or whatever?
I do listen to podcasts, A Master's in Business.
Yeah.
However, there's a new thing that I've been doing. Actually, it's not a book. All right. And it'll probably hit everybody differently on what I'm doing here.
Okay.
And I could tell you I got this from a good friend of mine, and he's going to kill me for saying this. So I'm good. A friend of mine, his name is Matt Bellamy. He's the lead singer to Muse.
Okay.
And he actually taught me this, so I can't take credit for this. We go into ChatGPT, and he actually sent me the prompt. And we prompt ChatGPT, tell me in the last 2 weeks what you have learned that is beyond human comprehension. Something along those lines.
How fascinating.
And by the way, it spits out all this stuff. Because if you think about it, humans, like as a human, you could get a PhD in biology. You get a PhD in astrophysics. You get a PhD in chemistry. But like you're the expert in their field. But think about this, that like ChatGPT passed the bar exam in like, I don't know, like a couple weeks, right? So it's becoming experts in everything, and then it's combining all of those things together. So how many like PhDs in chemistry, astrophysics do you have that like have like the expert in everything? And then what comes out? Like you tend to learn so many things that like, by the way, it turns into this rabbit hole. And I noticed that my prompt actually, because I always tell it to me like, explain it to me like I'm 16. So I've been driving into this other thing of, it's been teaching me about quantum entanglement. Are you familiar with this?
Of course.
Well,
who isn't familiar with spooky action at a distance? I mean, they teach that in middle school.
Yeah, exactly. So the quantum entanglement of that you have two protons that, if you do one to X, Y will do the same. It's just like having two dice. If dice on Earth, by the way, they've proven this. Like if you roll the dice on Earth, it rolls a 6, it'll definitely roll a 6. And it's not bound by space and time. So basically it could be light years away. You roll that dice, it rolls an 8. This one on Earth is going to roll an 8. And so then they sort of combine that with, is that part of human consciousness? That is your consciousness quantum entangled is what makes you. By the way, this type of like thinking. Like,
there's a related topic, and I haven't run this through ChatGPT, but I should, which is the concept of emergence, intelligence emergence, as the natural outcome of the universe. Why does the universe exist if not to create a conscious intelligence? Although the flip side of that is, life is fairly common throughout the universe, hydrogen, carbon, oxygen, nitrogen, but advanced technological life so far at least appears to be exceedingly rare. Yeah. So that's the counterbalance of emergence.
Totally.
But
and then the other thing that I found recently that people can dig into, I think this is fascinating, is that your head experiences time different than your feet from the proximity of gravity's.
Well, certainly we have to adjust GPS for the relativity.
Yeah, the GPS
which Einstein turned out to be right about that.
Exactly. So,
but the difference between your head and feet is so tiny unless you're falling into a black hole, and then spaghettification is the problem.
Yeah, so then you take quantum entanglement. And you then say, okay, if I have a proton here and a proton elsewhere, and the light in how that proton experiences time through entanglement versus how time bends with gravity. By the way, all of this just keeps going deeper and deeper and deeper.
Way down the rabbit hole.
And then the thing is that I keep telling it to explain it to me like I'm 16. Now my entire prompt explains everything. I will explain it to you as if you're 16 years old.
So the issue I occasionally run into with Perplexity or ChatGPT is it tends to conform its output to you.
Yes.
And sometimes I'll ask a question and it's like, no, I don't want a list of 10 podcast questions. I just tell me about Jeff Chang and what led to Vest. Don't give me a podcast. I have my own questions.
That's why I use multiple Grok, everything else. That way I get a whole plethora. And then what ends up happening is you get all this new stuff and then you dig deep into whatever topic. And I found that so fascinating because it's curiosity. It's like
if you're interested in these sorts of things, absolutely.
But
you have to be on guard for the occasional hallucination.
Oh, 100%.
And every now and then, I find myself leaving AI to go to just traditional search and say, "Hey, show me a source for this. Is this?"
Yeah.
I don't think before AI, I don't think people were skeptical enough about the sources of what they consumed. With AI, you really have to know what is real and what is fake. People miss that. All right, our final two questions. What sort of advice would you give to a recent college grad interested in a career in asset management or ETFs specifically?
Yeah, I think a recent college grad, I think similar to kind of bringing it full circle, same thing, like develop the skills that, you're not beholden to anybody. Right? Whatever that is, whether you're in college or out of college, like develop those skills that you can that they're portable, one to the other. And then not be afraid of failure. Take chances. Now, this is not for everybody, I would say, meaning not everybody is going to be a founder. Not everybody's going to be an entrepreneur, which by the way, I find as two different people. Founder has the creativity, an entrepreneur has the grit and influence. A founder has to have the creativity because you're actually introducing a whole new industry or a whole new thing that somebody else has not seen yet, right? But that's the thing. And then also keep your eye out for painful problems that you have the skill set to solve. So obtain those skill sets and then have your eyes peeled throughout life. Write them down.
Look for pain points.
Look for pain points. Look for problems. And then the last thing is just a personal thing is don't take yourself too seriously, right? Have fun with life. And I think that is because otherwise all this stuff can create massive amounts of burnout.
And our final question, what do you know about the world of buffered funds, investing, ETFs today? Might have been helpful 15, 20 years ago when you were first getting started?
How hard it would have been, right? Like literally.
Would that have discouraged you from launching?
Yes, I think that was actually the superpower, right? Like when you climb a mountain and you don't know how high it is and there's a cloud base, if you saw it in a clear view, it probably wouldn't be. If you told me to quit my job and I wouldn't get paid for 4+ years, I probably wouldn't have done that. But then it's like always – success is always around the corner. At least you dream of it, right? Everybody sees what you are now. They don't see the pain where you're constantly just waiting for that cloud to clear on the next part of the mountain. Because I could tell you this, that like if you saw how big the mountain is, nobody would do it.
Huh, really, really interesting.
Yeah.
Thank you, Jeff, for being so generous with your time. We have been speaking with Jeff Chang, co-founder and president of Vest. If you enjoy this conversation, well, check out any of the 600 we've done over the past 12 years. You can find those at iTunes, Spotify, YouTube, Bloomberg, wherever you get your favorite podcasts. I would be remiss if I didn't thank the Croc staff that helps put these conversations together each week. Alexis Noriega is my video producer. Sean Russo is my researcher. Anna Luke is my podcast producer. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.